Drew, I want to go forward to, within all the distractions we've got right now, I believe there's a meeting on Wednesday where we're going to have a little bit of Fed activity as well. Is this just a done deal that we're going to see a higher interest rate
Pretty much. You know, if they, I think the Fed is very focused on making sure that markets stay in a not constrained way, but they don't want markets to be volatile. And if they were to not go on Wednesday, it would actually be more problematic than if they do go, as everyone expects.
Help Charles Kantor here. On a Taylor rule basis, we're not even near normalized. We're not even near restrictive, are we?
I don't believe so. I don't. You know, I think the Taylor rule is probably kind of in the mid threes right now. We're not near that. We should probably be higher, and you know how I feel, which is that I don't think the fundamentals of the U.S. economy have changed pre-crisis to now. You take off a few basis points for demographic shifts, but you know, the normal interest rate in the economy is going to be very close to what it was pre-crisis.
So, Charles, this brings it over from economics over to your world, which is the real rate. Is money free still?
Money's less free, but the real challenge in the equity markets is this fight against fundamental earnings and what you pay for those earnings against the prospects of higher, longer-term rates. And that's the course of volatility. So much of the last decade, you've got probably more from multiple expansion and less from earnings growth. I think over the last couple of years now, you're going to get as much from earnings growth and much less from multiple expansion, which will be a driver of volatility as well. For us, that's great because it's back to fundamentals and it's less about, you know, for how much longer will rates stay at close to zero.